Welcome to the Driven to Succeed Real Estate Podcast. I'm your host, Brandon Olson. And today I'm really just going to go into what does it take to buy a home from a lending standpoint? What are the processes that are in place? Why do we want certain things? How does it all work? And so forth. It might be very interesting to you or not, but I really wanted to give back and explain why some lenders are not made the same as other lenders, right? People get into all the time, what are loan costs and why does it cost so much to get a loan? It's not like buying a car. Buying a car, it's super easy. You go into the dealership, they can mark up the interest rate, they can sell you ancillary products, they can do all this stuff, and they just simply push the paper, a lender, credit scores, as long as everything aligns, you're good. Generally don't even have to show pay stubs or anything as long as you got the credit. Super easy, right? Buying a home, much different, bigger process. I mean, first of all, now cars are expensive today, so they are not no longer 15 to 20,000, 30, 60, 80, $100,000 plus. For even trucks that used to be like 50, $60,000. But long story short, what I really wanted to get into is the actual loan itself. Like who's all involved in it, why a lender, you might talk to one person, the next thing you know, you're getting pushed down the line to two other people and so forth. It does take a team. It takes a village to do a loan. And that's why there's costs associated with it. And that's why from one lender to the next, sometimes those costs can be great. And sometimes those experiences can be vastly different. So generally speaking, you go online, you get some cheap lender, you're going to see that in the actual process itself and communication and other things. So getting into it, I wanted to discuss what does that process look like? So let's say you want to buy a home and the first thing you do, you talk to your real estate agent or you meet with a real estate agent and say, are you pre-approved? No. Okay. Well, I got a guy, go talk to him, or I got a gal, go talk to her. And you go out and you talk to them. So you get pre-qualified. So they generally, kind of go over like, what do you do? What do you do for work? What is your credit like? What do you have for bills? What do you have for cash? And do a framework of what that looks like. And then start maybe even talking, well, we could do this, we could do that, but we really need to do an application first. So then you do a mortgage application online. And then they request the documentation. So we do need to back up what's on that piece of paper, not like an auto car dealer does, but like what the mortgage is, it's quite different. So you submit an application, they ask for W-2s, pay stubs, your ID, your bank statements, maybe even tax returns. Maybe you have a current home. So you need a mortgage statement, homeowner's declaration. So you need all of that stuff to identify everything on the application. And so we can pre-approve you from a debt to income standpoint, DTI, which is very big in this industry. Like if you ever hear the acronyms, DTI, it's debt to income. And you can't generally exceed 50% debt to income. Maybe if you go conventional or VA, or I mean FHA or VA, you can actually go up to 50 plus percent. Maybe even some cases I've heard 60% on a VA loan as long as it's approved eligible. Anyway, so you get pre-approved and that process, you do the submit the application, then a loan officer assistant or maybe just a loan officer will go in your file, pull the credit through, review everything, review your income, make sure that income is calculated properly. And that's where people really get into some different things because many different companies pay at different levels. Sometimes you might have overtime plus holiday, shift differential, things of that nature. And we have to be very accurate on that. Some of that stuff doesn't work if you don't have it for 2 years, and so forth. So we, as a loan officer and a loan officer assistant, we really have to be very clear on that. And a lot of times what lenders are doing now is before you even go shopping, we submit for a TBD, to be determined underwriting scenario. So make sure that we do have that full approval, which really does help you with that loan process. I recommend it for everybody because there's all kinds of things that can get uncovered in processing and underwriting, things that come up on a fraud report, like names, things of that nature. And we can clear a lot of that stuff up front. So we do that. So now you have the loan officer, you have your loan officer assistant. We're submitting to underwriting. So there's a processor. She's going to go in, or they are going to go in and review. I say she because my processor is a girl, and go into and just make sure we have all the proper information for the underwriter to make a decision. So then it goes on to the underwriters. Now you have four people already. That's just the very beginning process, right? So we get a TBD underwriting approval. We give a congratulations. Here's your pre-approval letter. You're out shopping. To say we have a max payment amount. Um, that you're out shopping for. A lot of times people talk about, well, what is my max purchase price? And we do give you a max purchase price because I mean that's your, let's face it, you're not going to be shopping in payment terms. You're going to be shopping in what is the purchase price. So okay, your max purchase price is 400,000 and a payment equals X. And that payment is what that 50% debt to income, what I was talking about, that's really what determines what that max purchase price is. So we've had it before too, where it's just because we can get you to a 400,000 because of this payment. Maybe that payment is not what you want because you have kids. We're not taking account. Maybe you have 3 or 4 kids. We're not taking into account, what it costs to have those kids, sports, food, clothing, all that different stuff. So just because we can get up there doesn't mean it's necessarily a good thing. So we always want to have those discussions with you in the first place to make sure, hey, are you comfortable with a payment on a $400,000 home? Because maybe you're not. Maybe we have to look at something that's 350 or 300 because we have other expenses and you want to be smart with your money. And we want to make sure we don't put you in a bad situation, right? So now we're out shopping, say for this $400,000 house, you get your, as a loan officer, we're going to work with your real estate agent, you're submitting offers. We're going to call that listing agent and say, hey, we have underwriting approval on this. We've pulled the credit. We've reviewed the assets. The income is all qualifying. We are good to go, right? So we help get that offer accepted for you. So now that we have an accepted offer, what happens next? The purchase agreement comes into the lender. We disclose the loan to you, go over the terms, make sure everything's all good on that end. You sign all your disclosures. It comes back in and we send it back on to processing. Now in processing, now we just added a loan processor assistant that opens up the file when we'll order title, appraisal, make sure the minimum requirements to go into a full processing and underwrite now is all there. We've already completed this process in this scenario, some of it, so it should be very simple, easy. But a typical turnaround time is anywhere from 24 to 48 hours for a lender in average markets. Busy markets, that can become different. If things change, rates drop, and all of a sudden we get super busy, that those timelines can change from 2, 4 to maybe 5, 6, 7 days I've seen, and you're trying to catch up. So that's why there's a lot of time that's involved. At the same time, you have a title company working with getting the title commitments out, making sure that there's no additional liens on the property. Everything is on title is clear. But they're going to do name searches, look up, and maybe this, if you have a typical name, you could have judgments that we have to discuss. That's not even yours. Simple, easy. You just say, that's not me. That's not, I don't know anything. That's just a simple like name. Sign off on it. No problem. So after that, underwriting is now reviewing your file and they come back with conditions. Typical, always get conditions. Some of it be like, hey, we need an updated pay stub, or we needed to clear the earnest money check that you wrote. Where's the homeowner's insurance? Make sure that is all properly handled as well. So now we get a conditional approval, and in your loan processor is going to look at the conditions and say, hey, these are the conditions that I need to take care of or we need to take care of on our side. And then here's the conditions of the loan officer and loan officer assistant conditions with the borrower. So we come back to you and looking to say, okay, we need this, this, and this, right? So we usually want to put timelines on those so that we can get that stuff done. Because we don't want to lose time. And this is very important. Sometimes people don't understand like how the process works and so forth. So we give those timelines, we get that stuff back. Maybe appraisal comes in. Now we have the appraisal done. Appraisal can have, a couple different routes that goes, right? One, which we mostly get, is a value supports the transaction and there's no conditions to be met. Now, if it does have conditions to be met, you get, something like health and safety for FHA. Typical is peeling paint. Older home, peeling paint. So they got to scrape it, chip it, and paint it. Doesn't even have to be the same color, but they can get all of that done. And then we have to have a re-inspection and so forth. Or maybe the appraisal came in. Maybe we had to go over list to get it, and the appraisal came in just short. So now we have to determine: are we negotiating that short appraisal gap, or are we paying that ourselves? So that's negotiation you do with your real estate agent and the seller. Um, we get all that taken care of. Go back in for a clear to close with the underwriter. Get all the conditions clear to close, and now we move on to your closing department, and you're closing in your title company. You have to reconcile the numbers. Once those are reconciled, your CDs are going out, closing disclosures. You sign those closing disclosures. There's an initial one that has to be sent. We usually try to send it 10 days in advance to meet the compliance. And then we send a final CD that says, here's what's exact cash to close. And we had everything figured out, what all the escrows are and everything. Then a funder is assigned. You go to closing, you sign for all the documentation. There's online remote closings that we're starting now, but most of it's done electronically. And then you get there, and it's a very short process that you just sign the mortgage note and the deed. And super easy process is what it's becoming. Others will take longer because you might be a complete paper process where you don't sign anything electronically. So they do review all of that in the first place. And then there's post closing. So now you have a post closing funder to make sure that we've got all the necessary documentation from the title company. And that way we make sure that your loan is funded. And people don't really realize all these different processes. And that's what that gets into, that loan costs, right? And why some loan costs in some companies are different than others. What my experience in the 9 years of doing this, I've seen loan costs vary a little bit, not a whole lot, a little bit, but then you see the ones that are really low and you're wondering, how do they do this? Well, then you find out from say you lose a loan, right? And you're like, this bank was a half a point lower and their cost was this and this. And then towards the end there, I've had it before, like, oh, we wish we really would have went with you. We didn't, they wouldn't return our phone calls. They didn't do this. They didn't do that. Like, they had this problem. We had to keep sending them documentation. And that's because a lot of that it's just really who you're working with, right? You really do want to focus on the professionals, and everybody has their own opinions on that. Most people want to make sure when they're buying a $400,000 home that that process is good. And my theory is always making sure that going through this process shouldn't be stressful for you. It's going to be stressful, but it shouldn't. We should be able to help alleviate that stress by taking the right steps, making sure we have a TBD underwriting approval up front eliminates a lot of that. But then clearly defining what every step of the process is along the way, and making sure that you understand what these things do for you, right? And why these things, or why we need this. A lot of times I'm explaining to people is like, here's why we need to get this updated, or here's what happens over here, and we don't make up the rules. Fannie Mae, Freddie Mac, FHA, VA, they all have agency guidelines. We have to follow those guidelines. We don't want to get in the weeds with you on those, but a lot of times I just explain, like, here's why we're asking for what we're asking for, because we have to determine this and this and this. So that's really what the loan process is. This is why you want to really do work with professionals, from your real estate agent, buyer's agents. There's a whole program going on right now where you're going to be able to, potentially negotiate more as a seller with not paying a buyer's agent as much, or doing some other things in that nature. So it's still going to come back to where this industry is from the real estate side and the mortgage side. There's a lot of really good people in this industry, and those are the people that you really do want to focus with and make sure that they help you get from start to finish. This is one of the most, or the biggest purchase in your life, and you want to make sure that it's a good process and it meets all of your needs. And now moving on. So a lot of people also ask, what does specifically, like Corey, my man over here, who runs this whole show here, gets everything ready for me. He bought a home, and he was asking typical first time home buyer questions, and there's things that you just don't know when you're buying a home. So we wanted to go through that, make sure as a first time home buyer, here's what the process looks like, here's what you need, here's what we need it, here's when we need it, and so forth. But questions, first time home buyer. Many times I get the questions are, is there any assistance? Yes and no, right? It depends on what your first time home buyer status is. You don't have to be, you could have owned a home in the past but sold it more than 3 years ago, you're actually considered a first-time home buyer again, which is good because there are programs you can take advantage of. Fannie Mae, Freddie Mac has a conventional loan, home ready or home possible, and if you're under income limits, which in the metro areas of Minnesota is $99,400. So if your salary is below that or your household income is below that, you can take advantage of lower rates and lower mortgage insurance costs. So it's fantastic. Um, Now, is there down payment assistance? Yes and no, right? Down payment assistance. So let's just say you make $150,000, but because you've had student loans, because you had kids, you have this, that, or the other, you may not have all of the 5% down plus closing costs to buy a home, right? So can you get assistance with that? Yes, you can. Um, Minnesota Housing, specifically where we're at, bond programs in many states, they have how much like loan, minimums that you need, but there's income limits that go with that. So if you're under the income limits, you can get that money and use it towards down closing with minimal out of pocket. Typically, it's like $1,000 out of pocket and so forth. And maybe you can get the seller to pay closing costs. And now you meet 3%, 3.5%, 5% down, which leads me right into the minimum requirements of down payment, right? So down payment requirements are for FHA, 3.5%, VA loan, 0%, right? USDA, rural development. So in rural outlying areas, 0% down. And then conventional, if you are in that home ready, home possible, you can get as low as 3% down, or the typical is 5% down. So there's myths out there too, where you have to have 20% down. That's not the case. I just talked about that. You can have less than 20% down. And a lot of people, and it's amazing that how many people believe that you have to have 20% down in order to buy a house. While it's good, it's great to have, but it becomes increasingly harder to put 20% down on a $400,000 house. That's $80,000 plus closing costs. So you could be close to $100,000 on closing costs out of pocket, right? 95, 98. There's ways we can work with that to get some lender credits and things that keep those closing costs down and so forth. So you have the typical down payments, and then closing costs become a big thing. So let's talk about closing costs. What are closing costs? Closing costs is going to be, if you look at a loan estimate or even a closing cost worksheet, it's going to break it down into sections. You're going to have the lender costs. So lender costs will be like processing, underwriting, some additional management fees to get everything going, origination, and discount points. Those are your typical fees and you see from a lender cost. So origination, some lenders will just charge a straight origination 1%. 0.5%, 3/4. They can move it all around, or they just show 0, and then they can give you options of discount points. So discount points is typically what most lenders show, right? If they show a rate, and to get this rate, it's going to be a discount point of 1%. So let's take a $400,000 loan amount. 1% would be $4,000, right? And you could go without a discount point, but then your rate is going to be higher, right? So when we talk about discount points, we're discounting that rate from, say, let's say 7.5% with no fees, to say 7% with a 1% discount. So that half a point will adjust your payment greatly. And then the $4,000 to get there, you look at, okay, well, it's say my payment is, with a half a point on a $400,000 loan amount, is let's say it's $150 less a month. So you divide $4,000 by 150 and you would get, okay, it's going to take me about 4 years to pay this back. But now this is a 30-year mortgage. The next 26 years, you are paying $150 less. So that fee really grows over time, is saving you that money. Now, a lot of people right now with higher interest rates and with the expectations of interest rates coming down, some people say, I don't want to pay that. I'll take the 7.5. because it might be likely in the next 2 to 3 years we're going to be refinancing that loan in the first place. Because now, if you paid that 4 grand, you're going to lose some of that money by refinancing. So that's a discussion that you have with your loan officer. What are your thoughts, and why would we want to do this? And sometimes we have to do it just to make sure the debt to income is there. But there's no guarantee that there is going to be a refinance in the next 2 to 3 years. It's likely in this today's world, but it's now guaranteed. So going back to the programs, right? You have down payment assistance, you have FHA loans, you have conventional loans, you have VA loans. This is what a good loan officer is going to look at. What is the best loan for you? And credit score has a lot to determine that, right? VA loan, you got to be a veteran at the minimum, right? But your credit score is going to dictate a lot of times if you're going to be doing an FHA loan versus a conventional loan, right? We may be able to get a conventional loan with a 660 credit score, even a 640, or even down to a 620. It's not going to say those interest rates are very good on that conventional loan. The lower the score on a conventional loan, the higher the rate's going to be. Whereas an FHA loan, Federal Housing Agency loan, is going to be a much lower rate across the board with lower scores. So that is really why a lot of people say first time home buyer is FHA, is because a lot of times the scores are not a 700 plus. Maybe they are in the mid sixes, and you are younger, you just don't have that established credit history and so forth, and maybe just higher debt to incomes, and it keeps the score a little bit lower. Well, that's where we want to look at, okay, FHA loan over here with upfront mortgage insurance, which is 1.75% of the loan amount. And then there's 0.55% if you're doing a typical 3.5% down, 0.5% annually is divided out, but it's a smaller number. So that mortgage insurance isn't as high. And with a 640, 660 credit score, and you're doing 5% down on a conventional loan, that mortgage insurance over here might be like 1.5, 1.7, 1.3. It could be very big. So the payment over here would be a lot greater on this conventional loan. So I would say, hey, let's go with this FHA loan over here, much lower payment. And then, as we build over the next few years, and for sure when rates come on, let's refinance you into that conventional loan. And maybe you now have the equity and you no longer have to have mortgage insurance in the first place. So there's a lot that goes into why we are picking and choosing these loan programs and looking at these options. Sometimes it takes a bit of time to run the different scenarios to show you, hey, this is what it looks like from an FHA. This is what it looks like with different down payment assistance or down payment scenarios and so forth. So going back to credit score, a lot of people, the question becomes, hey, I've had a couple of hiccups. I got a collection. Can I even buy a home? Yes, you can. FHA will actually go down to a 500 credit score as long as you put 10% down if you're under 580. Generally, it's hard to get 10% down 580, but there's numerous reasons why that does happen. But typically, FHA will go down to a 580 score at 3.5% down. And let's say you do have a collection. Let's say it's outstanding, it's $3,400. Maybe we can fit into your debt to income 5% of that $3,400 as a payment, and it works. And now we don't have to pay that collection off. We still get approved eligible. We still bring our own funds. We're still ready to go. That happens a lot. I had recently had a guest on, Rick Wenner for Credit Life. He can help people get that score from a 580 to maybe a 600 or maybe a 620 or maybe even 650 or beyond, which greatly helps the cost of the loan, interest rate, points to buy the rate, and so forth. That's the cost of the loan. So there's a lot of different things that can be done. Again, professionals like myself, I have these resources, I have these partners. We want to make sure that we get you in front of the right people and understand what we can do to really help. Specifically in that nature is, let's say we have a 585 score, but when I pull your credit, it'll show me, hey, a score improvement of 60 points. We pay down a couple credit cards. Hey, can we pay down those credit cards, re-pull your score in a month or maybe 2 months, and now we have a 620 score or a 640 score, and now your loan costs makes up all that difference you just used to pay down those credit cards. And for example, a 580 credit score, the discount points, origination points that you have to pay on that, maybe that's 7 or 8 thousand, depending on the loan amount, just to get an interest rate. But maybe we took that $7,000, $8,000, paid those off, waited 2 months, and now we have a 620 score, and now we're just a one discount point. So there's ways that you really want to look at those different opportunities. We can still do those loans for you. Um, you with a lender such as myself, we can do those loans. We have many loan programs. Not all lenders are created equal, though. Just like I said early on this podcast, some lenders can't do it. They have minimums. We don't do FHA loans. Typical credit unions don't do FHA loans. They might have somebody that they can send an FHA loan to. They just can't do themselves. And they have a 620 minimum credit score requirement, and you just kind of get pushed along the side. Whereas I can do those different types of loans. Student loans, another big myth. I have student loans, I can't buy a house. That's not true. You can, just depends on what. It depends on your income, right? So let's just say you did go to a very good school and you have $150,000 worth of school, and maybe you're just starting out in your program and you're at the lower income levels in that program, but in a couple of years you're going to be at those levels, right? So we have to take student loans into effect. Maybe they're still in deferment. We will have to, depending on the loan program, FHA requires us to count 0.5% of that loan balance. So essentially, you have a $100,000 loan, that would be a $500 monthly payment. Then, so as long as we fit that into your debt to income, we're good to go. So it can certainly be done. And it's always worth just talking to myself or another loan officer and discussing what that looks like. Last but not least, when you're choosing your loan officer, or you're typically, maybe somebody, your agent is probably the biggest resource to refer somebody to you. You want to have that conversation. You just don't know those questions to ask, right? And I tell everybody, listen, you don't know these questions. They're going to come. Just don't hesitate. Reach out. A good loan officer, a good loan officer assistant, or a good team is going to get back to you. It's going to explain everything and make sure that we're doing right by you. I came from the auto industry, and it was my job to make money for the dealership. It's still my job to make money for the company by selling loans, but our job doesn't pay us any different besides finding you the best loan product. So with that being said, I gave you a ton of information. We got 30 minutes in this podcast. I'm hoping to break this all up and send it to you in segments if we need to, but I wish you all the best. Please reach out with any questions to myself. Like and subscribe, and DM me if you have any questions right now. Thank you.